There will be no quick video editing or flashy edits here, only useful practical information. And remember, the last point that we will consider is the most important. Enjoy the video. If you are wondering which stocks to buy in June 2026, stay with me until the end, because the best opportunity may not be the loudest name on the screen. In this video, I am going to break down the stocks that look most interesting right now, and I will separate the high-conviction ideas from the higher-risk bets. That matters because not every stock that looks exciting is actually a good buy, and the wrong choice can hurt your portfolio for months. By the time this video ends, you will understand which sectors are leading, which stocks have real fundamentals behind them, and which names deserve a closer look before you put in a single dollar. So do not click away early, because the last stock on this list may be the one that makes the most sense for your goals. First, let us talk about what the market is rewarding in 2026. Information technology has been one of the strongest sectors this year, helped by ongoing AI spending and strong semiconductor earnings. Energy has also been strong, partly because data centers need more power and the broader market still values reliable cash flow. Healthcare has held up well too, thanks to drug demand, biotech activity, and investors looking for balance in a volatile market. That means the smartest June 2026 stock picks are not just random hype plays, but businesses tied to real trends. Let us start with NVIDIA. NVIDIA remains one of the clearest ways to play the AI boom, because companies still need its chips, software, and ecosystem to build the next generation of products. The reason investors keep watching NVIDIA is simple. AI is not a short story anymore. It is a long infrastructure build-out. If AI spending keeps expanding, NVIDIA could keep benefiting from both demand and investor confidence. But this is not a stock for people who panic at volatility because expectations are already high. Next is Microsoft. Microsoft is interesting because it gives investors AI exposure without depending on one product cycle. Between cloud, enterprise software, and AI integration, Microsoft has multiple engines that can keep compounding over time. For many investors, this is the kind of stock that looks boring at first and powerful over the long run. If you want a name that can potentially hold up in both good markets and bad ones, Microsoft belongs on the short list. Third, we need to talk about Broadcom. Broadcom is one of the most attractive AI infrastructure stocks because it benefits from chips, networking, and custom hardware demand. It is not trying to be flashy, but it keeps showing up where the spending is real. That is why some investors view it as a quieter way to participate in the same megatrend that drives the biggest tech names. If you want AI exposure with a more diversified business model, Broadcom deserves serious attention. Now, let us shift to a name that gives growth plus resilience: Eli Lilly. Eli Lilly has become one of the most important healthcare stocks in the market because demand for its drugs is still massive and the category continues to expand. Healthcare can be a strong place to hide when the market gets noisy, but Lilly also offers real growth, which is why it stands out. This is the kind of stock that can work for investors who want a strong, long-term theme without depending entirely on tech. In a market where everyone chases the same AI names, healthcare can give your portfolio a much-needed second engine. Another stock worth watching is Berkshire Hathaway. Berkshire matters because it gives you a diversified, battle-tested way to own parts of the US economy without trying to predict one single trend. It has cash, operating businesses, and a long history of disciplined capital allocation, which is exactly what many investors want in uncertain markets. This is not the type of stock that promises overnight excitement, but it can help steady a portfolio when emotions run high. If you want something built for patience, Berkshire is one of the strongest names to consider. Now, we move to a stock that many investors still underestimate: Visa. Visa benefits from the simple fact that global spending keeps moving through digital rails, and that trend is still growing. It is not a dramatic story, but it is one of the cleanest business models in the market. When you combine scale, profitability, and long-term payment growth, you get a stock that can compound quietly for years. For investors who like quality over hype, Visa should be on the watch list. Let us not ignore the energy trade. Energy has been a strong sector in 2026, and the AI build-out has increased attention on companies that power the infrastructure behind the internet. One name that stands out in this category is Vistra. Vistra has benefited from the connection between power demand and data center growth, which makes it an unusual but very relevant AI-adjacent play. If you believe electricity demand will keep rising, stocks like Vistra could remain important in this market cycle. Another energy-linked idea is ExxonMobil. Exxon gives investors exposure to a more traditional part of the market, but it still matters because energy remains central to the economy and to corporate profits. Some investors prefer pure growth, but others want dividends, scale, and cash generation, and Exxon fits that profile better than most. In a diversified June 2026 portfolio, energy should not be ignored. The key is not to overdo it, but to own the right names at the right size. Now let us add a more defensive idea: AbbVie. AbbVie is attractive because it combines healthcare stability with income potential, which is rare in a market that often forces you to choose one or the other. Dividend investors like this kind of stock because it can help generate cash flow while still participating in long-term growth themes. In uncertain times, companies with durable products and strong demand often become more valuable than investors expect. AbbVie is one of the better examples of that idea. Here is where I want to slow down, because this next part is the most important. The best stock to buy in June 2026 is not the one with the biggest headline. It is the one that fits your time horizon, your risk tolerance, and your portfolio balance. If you already own a lot of tech, adding more tech may increase risk instead of improving returns. If your portfolio is missing healthcare or energy, those sectors may offer better balance than another crowded growth name. That is why smart investors think in combinations, not just in individual tickers. So here is the simple June 2026 framework. If you want aggressive growth, look at Nvidia, Microsoft, and Broadcom. If you want a balance of growth and resilience, look at Eli Lilly, Berkshire Hathaway, and Visa. If you want income and real economy exposure, look at ExxonMobil, Vistra, and AbbVie. The right answer depends on what your portfolio is missing, not just on what is trending today. Before you buy anything, ask one question: what happens if the market gets rough for the next 6 months? The stocks that survive that test are usually the ones worth owning. That is why quality, cash flow, and durable demand matter more than excitement alone. It is also why watching the end of a stock video matters, because the best idea is often hidden behind the biggest name. The goal is not to sound smart for 1 week, but to build wealth for years. So if I had to keep this June 2026 list tight, I would focus on Nvidia, Microsoft, Broadcom, Eli Lilly, Berkshire Hathaway, Visa, ExxonMobil, Vistra, and AbbVie. Those names cover growth, defense, income, and real economic demand. That mix gives you a much better shot at handling whatever the market does next. And that is the real secret most investors miss. The best stocks are not just the ones people talk about most, but the ones that still make sense after the hype fades. If you want, I can turn this into a more cinematic YouTube script with hooks, pauses, B-roll cues, and on-screen text directions.